Hey everyone, this is Andrew. I want to share some thoughts that a model that my son has presented to me. He's worked at a hedge fund that was managing over $1 billion, rather large. And the idea is to take a long-term approach. As much as I'll say to do a long-term approach, it's also hard not to do anything at times because there's times where the markets really aren't overly healthy. And when we say healthy, we look at weekly charts and we want to make sure that we're below, I'm sorry, not below, above 50 period exponential moving averages, above 100-day, above 200-day. Because when you're involved in things like that, you have this long-term perspective to compound money. Just as an example, this is a company called IDEX, IDXX. Just imagine you bought it in 1991. It was at $1. Fast forward to today, you're basically at $473. However, there's some really ugly periods to go through. I mean, we had all kinds of crashes, and most people would not be able to hold through the crashes. So what we do is combine technicals along with fundamentals. Let's say here's IDXX. Hopefully it's loading, which it's like slow motion. And our model is really simple because only things that will hold up in the real world are really simple things. And you can see we're 100% invested. We're using basically a 10-week, a 20-week, and a 40-week moving average. Ideally, we want to be long when the 10-week or the 50-day is above the 100-day or the 20-week. And again, the 40-week. But you're going to see, let me just kind of shoot over here a little bit. There's times we went to cash. Ugly periods. I mean, who remembers the COVID crisis? But we scale out. It doesn't have to be all or nothing. We scale out, we scale in, and it's all technical, without thinking, without emotion, without anything. And what's best is it's done on a Sunday afternoon. You run through these stocks that are picked fundamentally, and you put on a technical filter above them, and then you go for the ride. And here you go. And you don't have to do that much. Here was it, an 81% return. That's it. This was a 40, actually buy and hold was an 81%. We did 46%, but we avoided the unknown because there's always going to be drawdowns and you never know how bad they're going to be. So we're trying to wear a seatbelt. So what we do is we identify from a fundamental basis, stocks that have high composite ratings, which you can see here, high earnings per share ratings, high earnings per share growth over 3 years, and earnings stability. And there's another really super cool thing in investors.com where you can grade stocks. And then also we look at is the return on equity. Then what we do is we determine our allocations by this. My son made up a formula based on these attributes to get an allocation ranking. So we know that we should put 5% of our money into, let's say, here it is, IDXX, and 4% in, let's go to this, in this Kinsale Capital. So what we're doing is combining fundamentals with technicals and just simple math in order to know what our allocation is. And like this stock, which is going to be 8%, is called Fortinite. And if you look at this one, let's see, FTNT. From a relative strength basis, it's much stronger than other stocks. So we give it a greater allocation, or actually, depending on the look-back period. So going back to here, everything is in here. Our allocations, these are when the company started. And we're looking to compound money over very, very long periods of time. As long as the relative strength is stronger than say, most of the stocks in the stock market. That's what these are right here. And the next one is we have it figured out where we have a $300,000 account size with the allocation, the moving averages, the number of shares, the entry, and we scale up. We buy 50% at the entry if we're above a 50-period exponential moving average. And then we're 2.5% above that 50-period exponential moving average. And we're 4% above it. And you can see the shares. So we have 15 shares, 9 shares, 6 shares. And we have immediately, our stops are prepared. Everything is thought out on all of these shares. And if you're starting now, because basically it would be starting now, that because many of these things are under the exponential moving averages. Let's just do BABA, let's say. You can see. You get a crossover of basically the 10 and the 20. So you're at a 50% allocation. And if we cross over to the 40, we have a 0 allocation. So we avoid the drawdown. And you can see how cool this is. Look here. And it'll tell me exactly. It'll tell me my allocation with Google Sheets. Take a second. It's going to be a 50% allocation. And if it drops even more, let's say we go below this 248, we're knocking on the door here. It's pretty close. So we go to cash. And also the next thing is we kick out Alibaba if the relative strength is diminishing, which it is, and we find the next one, and we've already filtered the next one ready to go. So again, what we're trying to do, and I know it sounds a lot of this is repetition, but on one level, we have a trading account, and that is more short-term. This is much more long-term. You can have multiple accounts doing multiple ideas. And the thing I really want to point out is money is made by sitting. That's Jesse Livermore's words, not mine. Sitting when the market is healthy and the shares, are healthy. All this is educational, trying to help you become better traders. I hope this helps you. If you have questions, you can ask. None of this is, any particular advice for anyone. I'm not a financial advisor. It's our own family's money. It's my wife's family's money, actually. And we're just here to try to teach. Thank you very much.